When you think about banks and life insurance, you might picture two completely separate industries. Banks are where you store and manage your money, your savings, checking accounts, and loans. Life insurance, on the other hand, is about protecting your family's financial future in case the unthinkable happens. At first glance, these two seem to operate in entirely different realms. But what if I told you there's a fascinating and little known connection between them? A strategy that ties these financial giants together in a way that could change how you think about saving, investing, and building wealth. Today, we're pulling back the curtain to reveal how banks use a powerful financial tool to grow their wealth and how you can use the same strategy to take control of your financial future. This isn't just about understanding banks or insurance. It's about discovering a proven method to make your money work harder, safer, and smarter. Let's dive in. Most of us trust banks to keep our money safe. You deposit your paycheck, tuck away some savings, and expect your funds to be there when you need them, whether it's for an emergency, a big purchase, or just paying the bills. But have you ever stopped to ask, what does the bank do with your money once it's in their hands? The reality is, your money doesn't just sit in a vault waiting for you to withdraw it. Banks are businesses, and like any business, their goal is to make a profit. To do that, they put your money to work. But how exactly do they do it, and why should you care? Let's break it down. In the United States, banks operate under a system called fractional reserve banking. This means they're only required to keep a small fraction, typically 10% of their total deposits on hand as liquid cash. So if you deposit $10,000 into your savings account, the bank only needs to keep $1,000 readily available. The other $9,000? They can use it to generate more money. Most people assume that banks use this money to issue loans. Think credit cards, mortgages, car loans, or business loans. And that's partly true. Lending is a big part of what banks do. But loans are just one piece of the puzzle. Banks have found another lesser-known way to grow their money that's safe, efficient, and comes with some incredible financial advantages. That secret weapon? Cash value life insurance. Here's where things get really interesting. Did you know that some of the largest banks in the world are pouring billions of dollars into cash value life insurance policies? Take Bank of America, for example. This financial powerhouse has invested a jaw-dropping $24 billion in cash value life insurance. That's billion with a B, a sum that's larger than the personal savings of most individuals and even many corporations combined. You might be wondering, why would a bank with access to every investment opportunity under the sun, stocks, bonds, real estate, you name it, choose to park such a massive amount of money in life insurance? The answer lies in a combination of safety, growth, and tax advantages that make this strategy a financial home run for banks. Let's explore why. To understand why banks love cash value life insurance, we need to look at how life insurance companies operate. Unlike banks, which can lend out 90% of their deposits, life insurance companies are required by law to keep 100% of their cash reserves on hand. If an insurance company promises to pay out $24 billion in death benefits to policyholders, it must have that $24 billion available, liquid, secure, and ready to go. This makes life insurance companies some of the most tightly regulated and financially stable institutions in the world. For banks, this is a game changer. When they invest in cash value life insurance, their money is protected in a way that few other investments can match. It's not exposed to the ups and downs of the stock market, the volatility of real estate, or the risks of other speculative ventures. The insurance company can't afford to gamble with that money. It's locked in, safe, and sound. So, how does this work? When a bank or an individual purchases a cash value life insurance policy, the money they pay into the policy is split into two parts. The insurance premium. A portion of the payment goes toward the cost of the life insurance coverage itself. This ensures that if the insured person passes away, a death benefit is paid out. The cash bucket. The rest of the money is allocated to a cash value account within the policy. This cash bucket grows over time, often earning interest based on the performance of the stock market or other financial indices. The beauty of this setup is that it combines the security of life insurance with the growth potential of an investment, all while minimizing risk. You might be thinking, if the cash value is tied to the stock market, why don't banks just invest directly in stocks? The answer comes down to risk management. The stock market can be a roller coaster, huge gains in good years, but painful losses in bad ones. For banks, which are responsible for safeguarding billions of dollars, that kind of volatility is a non-starter. Cash value life insurance offers a unique solution. Many policies, like Indexed Universal Life, IUL, tie the growth of the cash value to a stock market index, such as the S&P 500. But here's the key difference. These policies come with a zero floor. This means that if the market performs well, the cash value grows, sometimes significantly. But if the market crashes, the cash value doesn't lose value. It simply stays flat, protected from losses. This creates a win-win scenario for banks. They get the upside of market gains without the downside risk. If the safety and growth potential weren't enough, here's the real kicker. The tax treatment of cash value life insurance is a dream come true for banks. For tax purposes, life insurance is not considered an investment. This means that all the interest earned within the policy's cash value grows tax-free. Compare that to investing directly in the stock market or even contributing to a 401k, where gains are often subject to capital gains taxes or other IRS levies. Let's put this in perspective. If Bank of America's $24 billion in cash value life insurance earns a 10% return in a good year, that's $2.4 billion in gains, completely tax-free. That's an enormous advantage that allows banks to compound their wealth year after year without the taxman taking a cut. For banks, this tax-free growth is like rocket fuel for their balance sheets. Beyond safety and tax advantages, cash value life insurance offers two more perks that make it irresistible for banks. Liquidity. Because insurance companies are required to keep all their cash reserves on hand, banks know their money is always accessible if they need it. Unlike some investments that tie up funds for years, cash value life insurance offers flexibility. Death benefit. If the person insured by the policy passes away, the bank receives a large cash payout in addition to the accumulated cash value. This provides an extra layer of financial security. When you add it all up, safety, market-linked growth, tax-free gains, liquidity, and death benefits, it's no wonder banks are pouring billions into cash value life insurance. But here's the best part. This strategy isn't just for banks. You can use it too. The most exciting takeaway from this is that cash value life insurance isn't some exclusive tool reserved for financial giants. Regular people like you can apply for and benefit from these policies. Now, approval isn't automatic. It depends on factors like your health, age, and financial situation. But for many people, cash value life insurance is accessible and offers a powerful way to build wealth using the same principles banks rely on. By investing in a cash value life insurance policy, you can grow your savings with market-linked returns, but without the risk of losing money when the market takes a dive. Enjoy tax-free growth on your cash value, keeping more of your money working for you instead of going to the IRS. Access your funds for major life goals like funding retirement, buying real estate, or starting a business. Provide a death benefit for your loved ones, ensuring they're financially secure if something happens to you. In essence, you're cutting out the middleman, the bank, and taking advantage of the same financial tools that the world's largest institutions use to build and protect their wealth. It's like getting a backstage pass to the strategies the big players use. So how do real people use cash value life insurance in their own lives? The flexibility of these policies makes them a versatile tool for a wide range of financial goals. Here are just a few examples. Supplemental retirement income. By building up the cash value over time, you can create a tax-free source of income for your retirement years, supplementing your 401k or other savings. Real estate investments. Use the cash value as a down payment for a home, rental property, or even a vacation home. Business funding. Tap into your policy's cash value to start a new business, expand an existing one, or cover unexpected expenses. Family protection. Ensure your loved ones have a financial safety net with the policy's death benefit, creating a legacy of security. The beauty of cash value life insurance is that it's not a one-size-fits-all solution. You can tailor it to your unique needs and goals, whether you're planning for retirement, building wealth, or protecting your family. Let's take a closer look at how cash value life insurance actually works so you can see why it's such a powerful tool. When you pay premiums into a cash value life insurance policy, your money is divided into two parts. A portion goes toward the cost of the life insurance coverage itself. This is what ensures the death benefit. The rest is allocated to the cash value account, which grows over time based on interest or market performance. As you continue to pay premiums, the cash value builds, creating a pool of money you can access for various purposes. You can borrow against it, withdraw funds, or simply let it grow, depending on your needs. Many cash value policies, such as Indexed Universal Life (IUL), link the growth of the cash value to a stock market index like the S&P 500. These policies often include a cap, a maximum return, say 10 to 12%, and a floor, a minimum return, often 0%. This means you can participate in market gains up to the cap, but you're protected from losses if the market drops. It's like having the best of both worlds, growth potential without the risk. One of the standout features of cash value life insurance is the ability to take out loans against your cash value. These loans are not considered taxable income as long as the policy remains in force. This means you can access your money for major purchases or investments without triggering taxes or penalties, an advantage that's hard to find in other financial vehicles. If cash value life insurance is so powerful, why don't more people know about it? The answer lies in a combination of financial education gaps and industry incentives. Most people are never taught about cash value life insurance in school, and even basic financial literacy courses rarely cover it. The focus tends to be on traditional vehicles like savings accounts, 401ks, or mutual funds. As a result, many people are unaware of this strategy and its benefits. Banks and financial institutions have a vested interest in keeping this strategy under wraps. After all, they're profiting from your deposits by investing them in cash value life insurance and other vehicles while paying you minimal interest on your savings account. The less you know about their strategies, the more they benefit. There are also misconceptions about life insurance that keep people from exploring it. Many assume it's only for providing a death benefit, or that it's too expensive or complicated to be worthwhile. In reality, when structured correctly, cash value life insurance can be a game changer for building wealth. Like any financial strategy, cash value life insurance isn't perfect for everyone. It's important to understand the potential drawbacks before diving in. Approval for a cash value life insurance policy depends on factors like your health, age, and financial situation. If you have significant health issues, you may face higher premiums or be denied coverage altogether. Additionally, premiums for cash value policies are typically higher than for term life insurance, so you'll need to budget accordingly. The effectiveness of a cash value life insurance policy depends heavily on how it's structured. Fees, premium allocation, and the type of policy all play a role in how much cash value you build. Working with a knowledgeable advisor is critical to ensure the policy is designed to maximize growth and minimize costs. Cash value life insurance is a long-term strategy. It can take several years for the cash value to grow significantly, especially in the early years when fees and insurance costs are higher. Patience and discipline are key to making this strategy work. Ready to explore cash value life insurance for yourself? Here's a step-by-step guide to get started. Educate yourself. Learn about the different types of cash value life insurance, such as whole life, universal life, and indexed universal life. Understand the pros and cons of each and how they align with your goals. Assess your financial goals. Think about what you want to achieve, whether it's supplemental retirement income, funding a major purchase, or protecting your family. Consult a professional. Work with a licensed insurance agent or financial advisor who specializes in cash value life insurance. They can help you design a policy that fits your needs and budget. Apply and fund your policy. Complete the application process, which may include a health exam. Once approved, fund your policy consistently to maximize cash value growth. Monitor and adjust. Review your policy regularly to ensure it continues to meet your needs. Adjust premiums, beneficiaries, or coverage as your life circumstances change. Now that you know the secret behind how banks use cash value life insurance to grow their wealth, you have a choice. You can continue letting banks profit from your hard earned money, earning you a fraction of a percent in interest while they leverage your deposits for massive gains. Or you can take control of your financial future by using the same strategies the big players use. Some people will hear this and take action, transforming their financial trajectory. Others will let it pass by, staying stuck in the same old patterns. The difference comes down to one thing: action. The next time you walk into a bank or check your savings account balance, take a moment to think about what's really happening behind the scenes. Your bank isn't just holding your money, they're using it to build their own wealth, often through cash value life insurance. By understanding and applying this strategy yourself, you can unlock the same benefits: safety, growth, tax advantages, and financial flexibility. Whether you're planning for a retirement, saving for a big purchase, or simply looking to make your money work harder, cash value life insurance offers a powerful, underutilized tool. The question isn't whether it works, it's whether you'll take the step to make it work for you. The choice is yours, and the future it creates is up to you.